Howdy, y'all. Welcome to Liberty Call. Today is Friday, May 12th, 2023. Hope everybody's having a fantastic day out there and a good week. It has finally stopped raining here in Colorado. I was wondering if we needed to order up the Ark to come save us here on the hillside, but looks like we will survive another week. Anyway, still kind of overcast and gross, but at least the water stopped falling from the sky. So if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. Please give me some thumbs up, likes, shares, subscribes, follows, all that good stuff. Not the greatest day in the market again. Seems like everyone's on pins and needles about the debt default and everything going on there. I mean, we could just spend less money. I know I've been saying this over and over again, but it doesn't seem like the idiots in Washington want to do that. So they just rather wreck the country and let it fall apart, which, again, I have no problem with. I'd rather just fall apart now and we start over because the idiots in charge, they don't represent me and they don't represent a lot of the people I know. So, all righty, let's go ahead and jump into the numbers for today. Dow Jones was actually finished up flat. It was down more than 100 points most of the day. It was down 0.03%, 8 points. The S&P 500 finished up down 0.15%. It was down about 0.5% most of the day, closed at 41.24. Let's see here. NASDAQ was down 0.35%, closed at 12,284. VIX was up 0.59% today. It's at 1703. Canada was flat, up 0.01. Brazil was up 0.14. And Mexico was down 0.08% for the day. Headed over to Europe, Germany was up 0.5%. UK was up 0.31%. France was up 0.45%. Netherlands was up 0.25%. Spain was up 0.56%. Italy up 0.92%. Switzerland up 0.36%. And Portugal up 0.05%. Russian exchanges were in the red today. The MOEX was down 1.15%. The RTSI was down 2.46%. And the overnights in Asia, starting out with the Nikkei in Japan, it was up 0.9%. Australia up 0.07%. New Zealand up 0.69%. Starting out with the Shanghai in China, it was down 1.12%. The Shenzhen Component down 1.23%. China A50 down 1.15%. DJ Shanghai down 1.24%. Hang Seng down 0.59%. And the Taiwan weighted was fairly flat, down 0.08% for the day. All right, so that's everything there. Let's go ahead and jump over to the see how the market's finished up for the week. Start out with the S&P 500. Looks like it's going to finish the week off down about 0.25%. The the Dow Jones finishes the week off about 1.22% down. NASDAQ finish in the green. Looks like it was up about 0.75%. The Dow Utilities down 0.16%, and the Dow Transports going to finish the week off down about 2.5%. So all in all, not terrible. I mean, kind of a flat week for most of the indexes, but certainly not great. Let's go ahead and zoom out and take a look at the longer trend. As we can see, this downtrend began last January, about the 3rd or 4th of January 22, and we broke through the resistance here early in the year, but have really just been sideways. I mean, each time we've gone down, didn't break the most recent bottom, and then same thing here at the top. We haven't eclipsed this level here. So again, we just kind of been in this sideways pattern for a few months. And I mean, what I would, the way I look at this and the way I describe it to clients is, what do you think is going to happen over the next 6 to 12 months? So we have a greater likelihood of things being great, or do we think things are going to be bad? Well, with all the other, ancillary things going on in the periphery, I would say we have a greater likelihood of things, turning negative, especially since we haven't really bottomed and seen a capitulation in the market. But we shall see what happens with time. All righty. Let's go ahead and go through today's or the week's economic data that came out. Starting out with jobless claims. Initial jobless claims came in at 264,000. Forecast was 245. Last week's number was 242, so we went up by about 20,000 there. Continuing claims came in at 1.813 million. The forecast was 1.82 million. Last week's number was 1.801, so a little bit of a rise, but nothing too dramatic. The consumer price index year over year came in this week at 4.9% growth. The forecast was 5%, and last month's number was a 5%. So a little bit less than it was last month. Let's look at the month over month number. It was we had 0.4% growth from last month to this month. And again, if we were to total up all these months of inflation, we probably are in the 20 to 30% range from the beginning. But we'll talk about that later. The producer price index year over year grew at 2.3%. Forecast was 2.4. Last month's number was a 2.7%. The month over month number grew by 0.2%. Not too bad, pretty flat. Forecast was 0.3, and last month's number was a negative 0.4. So, alrighty. And last, the consumer sentiment came in at 57.7. Forecast was 63. Last month's number was a 63.5. So again, a bit of a drop from the last 2 months, which had held pretty steady around that 63 number. So, all right. Well, that is everything for the economic data that was on the docket for this week. Let's go through today's market recap. S&P 500 set for another weekly loss as tech drops on plunge in consumer sentiment. The S&P 500 stumbled on Friday, signaling another weekly loss as rising yields blunted tech stocks and a plunge in consumer sentiment to six-month lows triggered caution on Wall Street. The melt-up in tech stocks came to a halt as Treasury yields regained momentum, and the Fed suggested that further rate hikes might be necessary as inflation remains too high and labor markets too tight. Apple led the move lower in big tech, followed by Meta and Microsoft, though Alphabet bucked the trend to trade flat. Consumer stocks, including Amazon, Carnival, and Norwegian Cruise Lines, were among the worst hit. The struggles of regional banks continued to weigh on the broader market, with PacWest Bancorp dropping 3% after pledging more collateral to the Fed to allow it to borrow an additional $3.9 billion from the central bank's emergency lending facilities. The regional banking crisis is likely to deteriorate further as many banks have exposure to low-yielding assets at a time when higher interest rates are forcing them to offer more attractive rates of return, pushing up their funding costs and pressuring margins. And something that I heard just anecdotally, on a financial podcast this week was that the Fed's go-to with the banking system is to do a stress test. But from what they were saying was that they've never conducted a stress test in a rising rate environment, which we're in right now. They've always done it with either flat or declining rates. And so it'll be interesting to see, have they gone and stress tested maybe behind the scenes and just didn't want to, put that information out there to scare the crap out of people? I don't know. But, be careful, people. Just, make sure your money's in good places, that it's not going to disappear on you. In deal news, First Solar jumped 25% after the solar company announced a deal to acquire Evolar AB for up to $80 million. Or I assume it's $80 million because one M is 1,000, so two M's would be million. So I'm assuming it's $80 million to accelerate its development of photovoltaic technology. On the political front, there were hopes of progress in talks in Washington among lawmakers on legislation to raise the debt ceiling and avoid a U.S. default on its debt payments. U.S. credit default swaps on treasuries have been on the rise, suggesting worries about a default are growing. The chance of a U.S. default is about 2%, according to Reese Williams, chief strategist at Spouting Rock Asset Management, who added that markets could sell off as the risk of a no deal on raising the debt ceiling grows. However, any losses would be recovered quickly as soon as the deal is announced. He recommends a 60-40 stock-to-bond portfolio allocation to cushion the risk of a default. If there is a debt default, government bonds are going to go up because that is very economy negative, and bank stocks are going to lose money while bonds are going to make money. All right, so everyone's more back on pins and needles again about the debt default, but again, just spend less. It's not that hard. If what I would do personally is, if all the revenue that came in for 2022, that's how much you can spend for 2023. Not a dollar more. And personally, I would put some qualifiers in there until you get the debt paid off. I'd say you can only spend 50% of the revenue from the previous year, and the rest of it goes towards debt service and paying down the debt. At this rate, they're bringing in $4 to $6 trillion a year. I think $2 trillion is more than enough to, pay all the welfare recipients and parasites who suck on the government teat. But, is what it is. All right, one last article here comes from the Mises Institute, and it's written by Stephen Anderson. It's titled, In the Event of an Official U.S. Bankruptcy. So let me bring up my notes. Let's see what they have to say. The current known federal debt in the U.S. is about $31.7 trillion, according to the U.S. Debt Clock website, which amounts to approximately $94,726 for every man, woman, and child who are citizens as of April 24th, 2023. And I think per taxpayer, it's probably over 200,000 at this point, since only about a third of us actually pay taxes. Where was I? The St. Louis Federal Reserve Branch released a report on March 6th, confirmed a similar figure of $31.4 trillion as of December 31st, 2022. It's virtually impossible for the government to repay the debt in its present state. Governments and businesses alike usually go bankrupt when their debts become unmanageable. For instance, Chapter 7 bankruptcy is liquidation proceeding available to consumers and businesses where debtors' assets are not exempt from creditors, are collected, liquidated, and distributed to creditors. Chapter 11 bankruptcy, on the other hand, provides a procedure by which an individual or business can reorganize its debts while still operating. Municipalities can file for Chapter 9 bankruptcy to protect themselves from creditors and negotiate a plan for adjusting their debts. Such bankruptcies are often result in bondholders experiencing financial losses that they cannot fully recover, while each governmental entity goes through reforms. Sovereign government defaults have occurred in recent times in countries such as Argentina, South Korea, Indonesia, Thailand, Greece, and Russia. The outcomes of such defaults have led to sovereign government debt bond ratings being reduced by private rating agencies. I mean, the same agencies that a decade ago said the U.S. was in good shape, but or a decade and a half ago said the housing market was fine. All those debt instruments that they created back 15 years ago, which collapsed the economy then. Again, I wouldn't put a whole lot of stock in rating agencies. They can be bought and paid for just like scientists and pharma companies and politicians. Debt repayments being renegotiated with bank lenders, countries receiving loans with a repayment plan from the International Monetary Fund, reform being required for entitlement programs, and a number of government taxes being raised. Their currency losing value on currency trading exchanges, price inflation becoming more of a reality to its citizens, and higher interest rates being offered on future government debt bond offerings. Very few in the financial world are talking about the outcomes of the U.S. federal government's debt default. One outcome after the 2011 near default was S&P lowering its federal bond rating from AAA to AA+, where it has remained since. In the event of a federal government debt default, there would be a lowered federal bond rating by 3 private bond rating agencies. The reality of higher interest rates being offered on newly issued federal debt cannot be ignored. Federal government spending cuts in some form will be required by the realities of economic law, including reducing the number of federal employees, abolishing federal agencies, reducing and reforming military budgets, selling federal government property. I would like some space over in Rocky Mountain National Park. I think 1,000 acres would be good compensation for the close to $1 million that the federal government has stolen from me and my wife. I think we take some land. Where was I? Selling government property, delegating federal programs to the states, and reforming the federal entitlement programs of Medicaid, Medicare, and Social Security. Federal government tax revenue to repay the known debt with interest will rise as a percentage of each year's future federal budget. The federal government debt default would have one real impact. The U.S. dollar would no longer be the global reserve currency, and dollars in many national reserve banks would come back to the U.S. Nations holding federal debt paper would have to deal with the consequences as well. It is imperative to get the fiscal business in order by defaulting, declaring sovereign bankruptcy, and making the necessary changes. It will not be an easy process, but is the best solution for bondholders, taxpayers, and other interested parties. So in Mr. Anderson's view, he kind of views it the same way I do, that default, collapsing of the government is probably the best thing ever. I mean, if you got rid of the U.S. federal government, I bet the people over in the Middle East would be thrilled. They wouldn't continually get drone bombed and all the problems that we've caused over there. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful weekend, and I'll talk to you next time. Adios.